Good morning. It is August 16th, 2019, and I am Kirk Spano in Springfield, Massachusetts, via Cleveland from Milwaukee. So on my annual August East Coast road trip, this year I brought my buddy Greg, my girlfriend Jolene, who's off of work at the moment, and my dog. So this is my 11-year-old dog's last trip east, I think. I don't know. We'll see. It's it's a long drive. So I think we're all ready to hunker down in Connecticut starting tomorrow after we spend a little time in Boston today and tomorrow for a Red Sox game. 4 days in Connecticut, then 4 days in New Hampshire, and then coming back, and I think we're going to break the trip up into smaller segments. It's a lot of driving for 3 people and a dog. I want to talk about volatility in the market, where we really are in the market right now, all the narratives that are out there that are pushing the market around, how we got that volatility trade so perfect, why those puts on the S&P 500 work so well, and where do we go from here. So let's start with a long-term chart of the S&P 500. As you can see, starting late last century, the market really changed its dynamic. So part of these huge gains are just compounded interest, right? But a lot of it has to do with changes in monetary policy. So since we've gone away from the gold standard in the 70s, and then we embarked on a deficit spending approach under Ronald Reagan that everybody else has done as well, we have accumulated a lot of debt and a lot of unfunded liabilities, and basically we have taken from the future a lot of the gains that we would have otherwise had then. So is that good? Is that bad? If you're an Austrian economist type, you think it's bad. If you're a Keynesian, you kind of shrug your shoulders. If you're a modern monetary theory person, you think, oh, well, yeah, so what? So we'll just print money at some point. And the problem with the modern monetary theory, which we've talked about before, is that if you're chronically printing money, eventually the confidence in the currency disappears. And one of the biggest benefits for being an American is the dollar is sort of the free ride of the planet. We get a discount on basically everything by being a strong currency. So the idea that we want a weak currency that some people put out there is just, it's wrong that we want a weak currency. Now, do we want a super duper strong currency? Do we want to be like the Swiss franc or something where there's limited use for the currency, but the currency is very high because, Switzerland is a creditor nation? No, you don't want that either. You don't want either extreme, super powerful currency or super weak currency. What you want is a currency that's slightly stronger than the other currencies, but doesn't hamper economic growth. In the past, economic growth has been driven by the expansion of international trade. As I've talked about several times now, international trade has been almost directly correlated to rises in GDP growth. Now, the displacement of jobs has been a thorn in the side of many people. However, what we actually know is that about 80% of jobs that have been displaced in the last 20 years to 30 years have been due to technology. So the narrative that our jobs are being stolen by Mexico or China or wherever, right, the whole South Park thing, or they took our jobs, it's not really true. Only about 1 out of 5 jobs left because of wage competition, 4 out of 5 jobs left due to technology. And when I say left, I don't mean went anywhere. Those jobs just don't exist anymore. So factory line jobs, things like that, they just don't exist anymore because the machines are doing them. So where are we today? Well, there's another huge evolution in technology that's happening, and that's machine learning. Machine learning means that even those 1 in 5 jobs that were disappearing because of wage disparities from country to country, that's not even going to happen in the future because a machine, a robot in America versus Mexico versus China versus Europe, they're all cost about the same, right? And in fact, those machines are a little bit cheaper in the countries with stronger currencies. So when you take a look at what's coming, what you can surmise is that, well, if a machine can build something that I need right down the street or nearby anyway, and I'm the end consumer, goods will be produced, widgets will be produced near where the end consumers are. So supply chains aren't moving because there's a trade war with tariffs. Those guys are fighting yesterday's battle, which really wasn't that big of a battle to begin with. What we really have is machine learning, artificial intelligence, moving the supply chains closer to the end consumers, and that is going to change the world dramatically. It means that there's not really much point of having tariffs if end goods are going to be produced near where the consumers are. So there's necessarily going to be more produced in China than there is in America. Why? Because we have 330 million people and they have 1.4 billion. They have more end consumers. India is another great example of that. They have a younger population than China by far, so they're going to be one of the production powerhouses in the world. Why? Because they're going to have a lot of young consumers. Other countries that have young populations will end up being producers, but they won't export nearly as much as they used to unless they truly have some sort of a competitive advantage or comparative advantage, as it's known in economic terms. So in the United States, what is our comparative advantage? Just to really outline this, our comparative advantages are high skills, great technology, and commodities that other countries don't necessarily have, and then services. So our business services are better than most other countries. So when a developing nation needs expertise, we're one of the places that they come to. Or sales, even Canada. You know, I'm in Wisconsin, not today, but normally, and we have a lot of business with Canada. I believe Canada is Wisconsin's #1 trade partner. So when you take a look at what's really being bought and sold across borders, it's not widgets. It is the high-end stuff that somebody has an expertise in. It is services that require intellectual capital. It's commodities because a lot of countries don't have what America has. For example, we're the breadbasket of the world. We have more food than we could possibly eat. And, you know, we have soybeans that are rotting right now. And it looks like they overplanted corn and it didn't get wiped out as badly as we thought it was from the floods. So we're going to have a surplus of corn here in a month. So if you like corn, September is going to be a really good month for you. How does that impact the markets? Well, because of the deficit spending is always borrowing from the future. And we have done that in spades. But so is China, so is Japan, so is Europe. So the 4 biggest economies are probably in for a comeuppance. The United States is in the best position because we have a very large millennial generation that's just entering their household formation years and big spending years, big consumption years. So even though they're not quite the same type of spenders that maybe the boomers were, and as I heard one demographer stenographer say recently, who cares about the Xers? Nobody cares about you. You're too small of a generation. But the millennials, they are going to push things, and they will largely balance out the impact of the aging boomers who are going to be spending less and less. So how does that impact the market? At some point, we have to make a decision, and that decision is going to be, do we have a classic depression that would shake out the system of all the malinvestments, or do we somehow solve the debt problems that we have? I have given interviews, and I have talked about this over and over again. I don't think anybody has the stomach for a depression. I think that the politicians realize that any recession would have to be kept short, under 2 years. So I think it's very likely, and in fact, I think it's inevitable, that we get what's called helicopter money. And if they're smart, and with the quantitative easing, they weren't that smart, but maybe it was the first step, they will use that money to create a Social Security lockbox that can't be touched except for Social Security payments. They will probably, or hopefully, alleviate student loan debt so that those millions and millions of people who aren't spending right now can spend. They will rebuild infrastructure that climate change is demanding be repaired and rebuilt and improved and modernized, especially the water systems. We'll see what they do. And these aren't political ideas. I mean, these are truly economic ideas. The concept of modern monetary theory is that you just print money whenever you need it. And as long as you're doing it in your own currency, it doesn't matter. That's not true, because there is still international trade, and you have to buy things from abroad. And if your currency gets smashed, then you do get runaway inflation. So you have to use the printing press, the dollar printing press, in a way that it doesn't destroy the confidence in the currency. And the way to do that is with what's called a helicopter money drop. Ben Bernanke became famous for it, but it was really Milton Friedman's idea. And Milton Friedman was no Keynesian. He just said, look, if you get yourself into such a bind that you have to print money, you do it one time. The caveat is that you have to do it right. And at that point, you need to normalize things. So that's where modern monetary theory goes wrong, that they don't talk about normalizing things. They don't talk about balancing the budget or getting close to balancing the budget, spending within your means. They just keep printing. What we could do with $20 trillion, give or take, is we could fund Social Security for 100 years. We could rebuild the infrastructure. We could wipe out student loan debts, and then probably, have a couple sprinkles for other stuff. But if we do it, if we try to bail ourselves out next time with just purely quantitative easing, which is creating debt to have money for today, we're just kicking the can down the road again. So while quantitative easing did keep us from a much more severe financial crisis a decade ago, it did just kick the can down the road. And the can is going to stop at some point. We won't be able to kick it down the road. Maybe we can kick it down the road one more time next year, the year after, whenever the next recession comes. But eventually, all of the baby boomers are on Social Security and Medicare. That's late in the 2020s. At that point, we have to have an ultimate solution. We have to have something that prevents a depression and largely resets a lot of things. In my opinion, we should just do it now, because then we won't have to solve for as big of a problem. But we probably won't, because we never do anything that's decisive and smart until there's a real crisis. So that's why I don't think there's a financial crisis coming soon. I do think there's a small recession coming next year. The yield curves have inverted. The stock market has been jittery in the last month or so. Right? This is the last month. And right in here, I was telling everybody, buys and puts on S&P 500, and if you want to take part in the calls on the VIX, go ahead and do that. But sure enough, and we probably were buying the puts all through here. Market dropped, doubled or tripled our money on the puts, and we pulled more closely to double on the puts and more close to triple on the VIX calls. Here's the VIX index that we use. And what we know is that anytime the VIX gets down to 10 or 12, it generally jumps up. And lately, 12 has been the trigger number. That's last year or two. It used to be that the VIX could get all the way down 10. That hasn't happened for a while. So if you just keep on going back, you can almost universally buy VIX calls when the VIX is near 10. And like I said, lately it's been 12. So at the start of 2018, we bought VIX calls right in here. Those articles are out there for people who want to read them. And then we actually had people who made 600% on those calls in a couple weeks. We didn't do this trade. I thought VIX should come down a little bit more, and it didn't before it rallied. These bottoms here aren't getting quite as low anymore. So we got the jump in the VIX. People made up to 300% on their VXX trades, right? You don't trade the index, you trade the attached security. And now we're getting the jitterbug. And what happens next? I don't know. I call this an in-between market. What do I tell you about in-between markets? Just don't play. If this VIX comes down here on some sort of trade agreement or just whatever, the end of quantitative tightening rally that I think we might get, if the VIX gets back down to 12-ish, 11-ish, 10-ish especially, you're going to want to buy those calls again. And again, 3, 4, 5, 6% of your portfolio. It's a hedge, not a speculation. In case volatility stays low for an extended period, your 2 and 3 month calls, which you might have to roll, don't kill you. Now, let's suppose that the VIX jumps way up here into the 30s. Well, if the VIX jumps into the 30s, there is a ETF, ETN, that operates in a inverse fashion. So, one year, I guess. They had to reset all of these. You see how they converge and then they diverge? This is an inverse volatility ETN. So when volatility goes up, this one falls. When volatility falls, this one rises. So if we get a spike in volatility into the 30s, this ETN is going to get crushed. But then, as volatility comes back down, this one rises. Very simple relationship. So if we operate off of the extremes, we can use VXX and SVXY, right? Red and blue are, this is the VIX. This is a VIX ETN correlated. And then this one moves in an opposite direction. You can really see it when you compare the orange and red lines, right? They're mirror images. So off of the extremes, 30s, close to 10, we can use these as a hedging program. I will put everything into an article and explain this. I know that the images don't always show up the best. So the SVXY and the VXX are the two volatility indexes that we can use. So I just wanted to point this out because, we made a lot of money on this trade. Basically dropped 6, 7, 8% points to the bottom line for the year in a couple of weeks. And given that I think volatility will be very volatile in the next year and a half, we want to be aware of these trades. And then in 2021, if the elections go the way I think they're going to go, if things start to go the way I think they're going to go by 2022, off of the spikes in volatility, one of the benefits of SVXY is that it naturally deteriorates. So as volatility goes down, you really can make a lot of money. So the deterioration on this ETN actually works in your favor. With most ETNs, it works against you. So we'll keep that in mind, and we'll talk about that in an article. So I want to also talk a little bit about S&P 500, QQQ, Power Shares, and NASDAQ 100, and dividend stocks. There's this narrative that dividend stocks always win, and that high dividend stocks are somehow low volatility. I have clients ask me about that because they hear it. And I'm just going to categorically call bullshit on a lot of this dividend narrative. The idea that growth stocks are inherently more volatile than dividend stocks is categorically wrong. And we can see that, and you just overlay chart after chart after chart. The difference in beta or volatility is negligible. It's a single-digit percentage. So given that there's no huge difference in volatility between dividend stocks and growth stocks that don't pay a dividend, which one would you rather have? And we've talked about new economy versus the old economy. Well, if you just compare the two indexes of the big stocks, you have the S&P 500, and I have both price and then price plus dividend. The S&P 500 is this red line since 1999, I believe. We start here, this chart. The S&P 500 is up 124%, just based on price. When you add the dividends, it's up 223%. The Invesco QQQ without dividends is up 261%, and with dividends is up 305%. QQQ represents the newer economy, the more growing economy. It crushes the S&P 500. And we can look at this over almost any time frame. 10 years. QQQ's up here. 5 years. QQQ's win. 3 years. QQQ's win. 1 year. 1 year is a small sampling, but even in this environment, QQQ wins. Right? Blue is on top. The dividends, because we have had almost no return now in the last 12 months because of the December slaughter, the dividends really account for most of what's going on. If we just pull this back to the start of 2018, so only about a year and a half, once again, QQQ on top. So there's virtually no reason why the narrative for dividend stocks being somehow low volatility or better returns should even be out there. It's not true. Now, dividend stocks with reinvested dividends have tended to do better if you pick the right stocks. And that's what it boils down to, is what are the right stocks. And the right stocks, as I've said, with dividend-paying stocks, you need a underlying growth trend in addition to a healthy balance sheet. And in the S&P 500, we have a big problem with that. A third of the stocks in the S&P 500 are financially in big trouble the next time a recession hits, even a small one. So we have to be very careful about what we pick out. So what do we want to own? Well, one of the things that we just bought was the Invesco stock, the actual stock. So Invesco administers and sells QQQ. This is the company that does it. And their chart shows that they've basically become dramatically oversold. So this is about as oversold as you can get. Buying Invesco stock right now is an incredibly good buy. Somebody in the last couple of weeks has started to figure that out. So there is some big money starting to go in and buy from the retail investors which are selling. So the retail investors have been drifting out. Big money probably sold out a bunch up here. And now the stock is oversold. So at these dramatically oversold levels, even on the weekly chart it's oversold, it's under 30. On the daily chart, it's just crushed. QQQ, company, Invesco, right? Invesco creates that. Got almost an 8% dividend. Actually, forward looking right now, it is 8%. They have a growth rate. The reason why the growth rate isn't higher, but it's still a growth rate. It's not zero growth like a lot of the S&P 500. The charts show up better in the replay. So sometimes live, they're not optimized. But in the replay, they'll all look pretty good. I've seen the replays. They all turn out pretty good. The merger with Oppenheimer has kept the growth numbers for these guys lower than what you would expect as more and more people become passive investors. The two companies that really are the big dogs in ETFs, right, are Invesco and BlackRock. BlackRock hasn't gotten beat up to the point where I'd want to buy it yet, but that's the other company. They do the iShares. So we want to look at BlackRock when we get a chance. Right now, Invesco is a buy. And if you're a dividend investor, you have a stock that's incredibly healthy, low debt, huge free cash flow, big dividend, and a growth rate to support underlying support for all of this. If this growth rate was negative, would that still be as attractive? No, because at some point, their free cash flow shrinks. That means their dividend becomes either a bigger percentage of free cash flow, meaning less secure, and we don't want that. So we need to have a growth rate underneath these dividends so that they don't become too big of a hunk of free cash flow and ultimately get cut, right? How many of you have owned stock where they cut the dividend, right? That sucks. And it's generally because the free cash flow isn't going up enough to support the dividend, or the free cash flow is shrinking. A third of the companies in the S&P 500 are going to run into the problem of free cash flows not being able to keep up with the dividend. Ultimately, the payout ratio goes up too high, and they have to cut the dividend. And when they cut the dividend, what happens next? Stock price goes down. What kinds of companies do we want to get into? I've talked about Google over and over again. You're not going to get a dividend with these guys, but pretty much as the world goes, Google goes. As Google goes, the world goes. So anytime Google pulls back to that around $1,000 a share, you want to buy it. It's been in this area here consolidating for a couple of years. This is a 3-year chart, right? So Google has been consolidating. It's just in this sideways choppy motion. When stocks are in a sideways choppy motion, it means one of two things. It's going to break out to the upside or break down to the downside. What do you think is going to happen with Google in the next year or 2 or 3? It's going to break out to the upside, I think. Why? Because their artificial intelligence is the best in the world. And that is incredibly important. They have all sorts of other companies within Alphabet, and I have coined the term baby Googles. The baby Googles are coming. Your dividends from Google are going to be entire companies. not $1 a share, not $2 a share, not $3 a share, but you're really looking at receiving 20 and 30 and $40 billion companies as a dividend. So Google should be a core part of your portfolio. They are the richest company in the world now. They have more money than Apple. And that is saying something because Apple had the most money for a long time. Speaking of Apple, this one. Whenever they take one of these diggers, like they did in December, you ought to be a buyer. You got down to about 150. I would buy them right around 160. I don't think they go much lower than that. You see that this level here has held. It's tested it. Maybe it'll test it again. And when it tests it again, I think you buy it, right? Now, in the recession scenario, could it go all the way down to 125, 130, right in that area? It could. And then you have to buy more. But Apple has growth rates on their services that is offsetting the slowdown in devices. So eventually, this number pivots back up on the growth because of all the recurring revenue. Their debt-to-equity ratio is kind of a joke because what they've done is they've just leveraged all their cash for tax reasons. Their dividend is growing if that's important to you, but what should really be important is this return of capital. These guys are buying back billions of dollars worth of shares. So this company is becoming more and more valuable, and they won't have much to spin off, if anything. But, you know, this is another company that should be a core to your stock portfolio if there's a recession, if there's a market correction, because in corrections, you don't want to speculate. You buy the highest quality stuff that you can buy. And Google and Apple are the two richest companies on the planet, and they are generating a growth rate that is more likely to accelerate than decelerate. Amazon, if you were reading about it, Berkshire Hathaway has started to invest in Amazon. And they're another company that's got this sideways choppy motion going on an extended period of time. This level here is pretty stable. Right in here, because we bought it about 1,500. Can they get down to 13, 14, 1,500 again? Probably. And in there, we want to buy it. You know, in an end of the world scenario, everything can go lower. Let's just talk about a regular run-of-the-mill recession. Basically, we'll erase the gains from the last year or two. So if I can get Amazon in that 1,300 area, 1,400 area, that's probably where I'm looking. First Solar is another one you want to buy on the dips. Why? As an article we'll be talking about soon, First Solar is going to be driven higher and higher and higher by the utilities converting over to solar power. First Solar is one of the three companies that really lead in that field. You know, Canadian Solar's in there. There's a private company in there. But First Solar is the leader, clearly, among the public companies. And they have an expertise. It's hard to beat these guys. It's not like slapping shingles on a roof. These guys are building big power plants. And we already know that the coal power plants are going away. And natural gas is not getting as much of that as we thought they would a year or two ago. The solar technology and the battery technology are catching up rapidly. The cost curves are crossing over as we speak. And First Solar is going to get more and more contracts from utilities, especially if there's a change in government policy in a year or two, in a couple of years. If the Democrats get into the White House, they don't need the Congress. If there's a Democratic president after next year, they're going to tighten up on oil drilling. They're going to tighten up on emissions. They're going to raise mileage standards. They're going to push the green agenda hard. And First Solar will be a huge beneficiary of that. And by the way, the actual economics and math actually supports them now at this point. In Indiana, we talked about this 3 other times. Coal power plant closed. Why? They could have kept it in operation for 20 more years. They decided to close it. The utility decided to close it because it was cheaper to build solar and alternative energy batteries. Other companies we want to take a look at, PayPal in the 90s or 80s. Walt Disney. So we're going to talk a little bit about entertainment and streaming media. Walt Disney jumped. He had this big gap up here. If I can get Walt Disney 120-ish, I want it, right? So if this gap closes, which it normally will, once it gets back down in this range, right about there, 120-ish, you should be buying Disney. Why? Because Hulu and Disney Plus, or whatever they're calling it, are going to be a big deal. Disney and the new Viacom CBS and Amazon Prime, although Prime I don't look as a big competitor to Netflix. Why? Because people have Prime for other reasons, right? People have Prime because of the delivery from the retail, so that's not something I think directly infringes on Netflix. But if Disney is going to withhold their library, if the new Viacom CBS is going to withhold their library, that makes it hard on Netflix. They have to do all original content, and they have some great shows, you know. House of Cards was real good until Spacey got in trouble, you know, and turns out that he was a creep. Stranger Things, I watched that. Stranger Things is good. They have all kinds of good documentaries. Netflix is going to survive, but they're not the juggernaut of growth that they used to be. And we saw that in the recent quarterly numbers. They had a decrease in subscribers. I was one of the people who quit Netflix. Why? My girlfriend's got it, and I have some other stuff. So why did we need 2 subscriptions? And also, there's a lot of sharing that they have to solve for. So can Netflix maintain their base and grow internationally? For sure. Are they going to dominate the streaming space like they used to? No, they have competition now. So Disney, AT&T with HBO, and then CBS Viacom, they're all going to add new revenues. So I'd rather look at Disney, AT&T, and Viacom CBS. I haven't done all the reading on Viacom CBS yet, but I suspect after this blow-off bottom here, I probably will want it as soon as the next couple of weeks. The other company for us to keep in mind, right here, CBS Corp, fell off a cliff here recently, just boom, 15%. Viacom, same thing, fell off a cliff. You know, look at that. All right, and not horrible debt numbers, but they're all right. So I'm going to take a look at them. But here's another company that I think is going to be in play. Do I have it here? Oh. Here's a company that I think is going to be in play on the international side. Sony. Anybody know why I think Sony is going to be in play? No, nobody? Sony Entertainment. Don't you think that Sony Entertainment could get bought by somebody? You think Sony might spin out Sony Entertainment? I do. Or maybe they even buy Netflix. But I think that there's a very good reason to think that Sony is in a good position here as the last major studio that hasn't made a move. So if we can get a pullback on Sony, I mean, I'd love to buy them down in the upper 30s, right around 40. I don't know if we'll get that chance, but I think any correction in Sony, we have to take a look at buying, because I think that the amount of money that's involved for them if they spin off Sony Entertainment, or they come up, or if they buy Netflix, I think it's better for them to spin off Sony Entertainment and maybe merge it with Netflix in return for cash and shares in Netflix. I think that if Sony invests in Netflix and gives them their library now and their studios, now all of a sudden Netflix looks awfully more attractive as its own entity, but Sony all of a sudden has all that new revenue. So how can Sony monetize Sony Entertainment? So I think that's probably coming. All right, last thing that we're going to cover today is the oil stocks. Put out this article today. Iran escalation, the Fed or a China deal could drive oil higher soon. So I covered the potential catalysts. And last week, our video talked about why the trade war is making an attack on Iran more likely. And, you know, I was scolded by the Seeking Alpha in-house chief editor who said that that's too speculative. Well, in the article, after I re-edited it, I point out that 2 years ago when I started talking about tensions rising with Iran, everybody said that I was crazy. There's no reason for Iran tensions to go higher. Well, since that's happened, since I wrote that first article, what's happened? Iran tensions have gotten tighter and harder, worse and worse and worse. We left the trade deal. We put sanctions on them. We have a maximum pressure policy. We've moved a fleet of ships over there. We're protecting oil cargo carriers, tankers. There's been tankers that have been hijacked, been taken by the Iranians. There's been a couple unexplained explosions in different places. Israel is on alert. So tension has clearly risen. China is circumventing the sanctions by taking oil from Iran and then not classifying it as an import. It just kind of sits there, but, they're not signing the paperwork is basically what it amounts to. China's taking oil from Iran. The Trump administration believes that 70% of Iran's oil is going to China. How do you put pressure on China? Figure out a way to disrupt that oil from Iran to China. It really comes down to that. We showed last week that China is thinking about sending its fleet or what they have of a navy to the Persian Gulf. Think about that. So before that happens, we need to attack Iran if we're going to do it. I'm not advocating for it. I'm just saying that as an analyst, if I'm President Trump and I want to accomplish all these things in the most Machiavellian way, how can I do it? Cutting off the supply of oil to China would put a lot of pressure on China to cut a deal with us on trade. That included oil and gas imports. The Fed could become much more dovish. We've seen Powell flip-flop before. I think we got another flip-flop coming. I think Powell is probably going to get much more dovish. I don't think he has a choice anymore. I don't know if that means we get QE soon, but I do think we probably get 2 more interest rate cuts this year. And if the economy shows a bad GDP growth number next quarter, we might see a 0.5 point. So, which companies do you want to buy if you want to speculate on oil companies making a big rebound? Well, what's the ones that are cash flow positive versus CapEx? Oh, this chart is not. Dang it! This chart is not working. All right. Well, Pioneer. This is Pioneer at this end. EOG, Conoco, Occidental. I don't know who that is. Devon Energy, Encana. And then Parsley Energy. So we're in Pioneer, we're in Occidental, we're in Devon, we're in Encana, we're in Parsley. And Parsley is a pure play in the Permian that we know is shopping itself. And we know that Devon has talked to somebody about a merger. I speculated that it might be Marathon, but it could be anybody. When you take a look at the maps or the production, you got Marathon. Got Devon, take a look and see where the overlap is. Permian, Bakken, Eagle Ford. So 3 of their basins overlap. And then you have Encana, which really, in my opinion, that Encana should sell everything and then just keep the Montney. And that should be the only thing they should be. They should go back to just being Energy of Canada and sell everything else. That's my opinion. I think that's how they maximize their value the best. We'll see what they do. All right. I'm not going to take questions today because I got to blow out of this hotel. I am going to write an article sometime this weekend. I'll set aside a couple hours to lay out the price levels that I see for the high quality stocks and for QQQ and ARC, some of the other ETFs that we want to be in. I would read this article if I were you. If you're not already an owner of Permian stocks, the 5 that I listed are the 5 that you want to be in. Maybe Centennial Developments, because they almost certainly are going to get bought out. The other thing, if you read the comment sections here, I talk about why private equity and management want to take some of these companies private. So from the current prices, you can make money just on them going private. Probably takes at least 1, if not 2 of the catalysts that I list to manifest in order to get all the way back to even. So the high prices on these stocks probably never set all-time highs again. They've probably set their all-time highs. But if you just take a look at the last 3 years, they probably get back to their 2 and 3-year highs, 2 and 5-year highs. At least their 2-year highs, right? So Pioneer almost certainly gets back to 180. Does it get into the 200s again? I don't know, maybe. Encana certainly should get back to around 10. Parsley should get into the 20s when they get bought out. Devon should probably get into the 30s again. And Occidental, the merger that Occidental is doing, people are saying that it's a bad merger. They don't understand what's going on in the whole oil market at this point. So I would suggest that you'll take a look at Occidental. It's a fat dividend. I saw the charts, right? They're one of the most cash flow positive. Right here's Occidental. Right here. One of the most cash flow positive versus CapEx. And they're going to spin off. They're going to sell virtually all of their non-core assets, and they're going to do it quickly. It took them a week to sell all their African assets. They're looking to sell a pipeline company. They're looking to sell offshore. I think they actually have a deal for offshore already. Occidental might shrink themselves down to a Texas-based company. Maybe they keep the Bakken. It makes sense for me that they would keep the Bakken just because there's not a lot of effort in them to keep it, and it throws off some free cash flow. So we'll see. But I think they're going to sell almost everything except for the Texas assets. They can make a run at being a debt-free company pretty quickly, 2, 3, 4 years out with any luck on oil prices. And I'm telling you, oil prices will go up if a Democrat gets in office. They always do. And I think that this time, the green agenda, even if it's Joe Biden, is going to be very, very, very strong. Everything underlying the Democratic Party is saying push that. And if the Democrats have Congress in particular, Biden's not going to sign what they send him. So, and then he'll do all the executive orders to boot. All right, I know that I am on Wi-Fi at a hotel, so this probably didn't look great while we were watching it. My understanding and experience with this is that it'll look better on the replay. So if you want to take a look at it again then for the charts, that's great. But I will put the charts into a number of articles over the next week or so. So between now and Labor Day, I'm just basically going to summarize everything that we've been talking about for the last couple of weeks in 4 or 5 articles. All right. Joe Biden with Obama as VP. I don't even know if that's legal. Actually, the data on Occidental is better with Anadarko because they've already announced that they're getting rid of all that CapEx. So I think Occidental's numbers get considerably better, not worse. Yeah, I'll take a look at some of these other companies they're asking about. No, I do not think CenturyLink's dividend is in trouble. They just put up really good numbers, and they already cut their dividend. I don't think they cut it again. There's really not a lot of need to. Their coverage ratio is getting better every quarter. So, and like I said, remember, here I'll finish with this. So we drove from Milwaukee to Springfield, Massachusetts, and we stopped for a couple days in Cleveland. And Cleveland is apparently a city that's going 5G, at least with AT&T right now, because I was getting 5G Evolution, which is their in-between step. And we were taking a look at, I was taking a look specifically, because I drove through the city a little bit, and then drove around. The cell towers, which I specifically was looking at, those 5G cell towers are going up everywhere. And even on the lights on the highway, there's a series of lights on the highway where they had cell, whatever those things are, the repeaters or whatever they're called. So the 5G is coming pretty fast because they're building the infrastructure. And I think that Verizon and AT&T obviously are going to do very well with that. I think the new T-Mobile Sprint is going to do really well with that. I think a number of regionals like U.S. Cellular, although I still think that they get bought. And then there's that Atlantic group that has a bunch of regionals under one umbrella, and there's one out west. But what they all need is fiber optic backbone. The two biggest fiber optic backbones are AT&T and then CenturyLink. CenturyLink at some point could just raise their rates to use their fiber optic, because you have to have fiber optics to actually have the 5G. So at some point, I think CenturyLink just says, hey guys, you're all going to pay a little bit more. It's coming. Their enterprise business is very good as well. So I would think that CenturyLink at these levels, 10, 11, 12, I think that you're going to look back in 3, 4, 5 years and go, wow, I wish I had bought at 10, 11, 12. Because not only do I think CenturyLink is going back into the 20s, I think ultimately that stock goes into the 30s, which is what I originally thought. I didn't think it would go from 20 to 10. I thought it would go from 20 to 30. At 30, I wasn't buying it, but I watched it go down to 20 when I started buying it. I started buying it too early. It happens. But I think at 10, 11, 12, you look at it and you go, okay, it's been jitterbugging around this level for a while now. I think that you have good entry spots here. So I like CenturyLink because they are very valuable assets, and ultimately they can influence the growth industries that will be tied to 5G. They have a big dark fiber network that they can activate and sell off space on. I think CenturyLink is in really good shape going forward. So they've taken their beating. They've waited for the future to get to them. The future is almost here on 5G. By next year, most big cities will have 5G by the end of the year, and the year after that, almost everybody will have it. So 5G is going to be here by 2020, 2021, 2022, right in there. CenturyLink is going to do very well for that, especially when they finally say, hey, you guys are all going to pay a little bit more. All right. Have a good one. I am playing at Foxwoods this weekend, so hopefully I come home a winner. Played a little bit at the Jack in Cleveland. If you are a PLO player, the Jack has 3, 4, 5 PLO games going at a time. It blew my mind. And a lot of the guys are really good. I looked up a couple of these guys, and I didn't know the PLO was a big thing in Cleveland, but it is. On the flip side, in Springfield, Massachusetts, strictly no one to hold them. So far, I've won all of my sessions, only $95 last night, just checking out Springfield. But it was fun. So if you're going to go to the Basketball Hall of Fame for some reason, and you're a poker player, or you just like casinos, Springfield here is pretty cool. I'm pretty impressed. I wish I had more time to hang out here. Cleveland, told you I love it. Had a little funny story. Went to the Nifty 50 Cafe in Madison, Ohio, because it got great reviews, and we went there, and it was awesome. And the woman who was behind the counter was very entertaining. She was doing her own little version of karaoke when the music came on. But I got distracted for 1 second as I pulled into a driveway and, had to avoid somebody and bumped into a pole. So the front of my car is stitched together like Frankenstein, and I have to get it repaired when I get home. But such is life. That is the third time I've had an accident on this Southeast trip in 10 years, so hopefully that is the last one ever. Other than that, if you're in the Mystic, Grogan area in the next couple of days, I'll be out there Sunday, Monday, Tuesday, Wednesday. Happy to meet up with you. If you're in the Center Harbor area, Wednesday, Thursday, Friday, Saturday, Sunday, happy to meet up with you. And, just get through to me at the direct messages on Seeking Alpha, or if you have my email address. Take care, everybody. Have a great weekend.